Confidence in Australia's property markets have leapt in the last few months, with most property commentators forecasting that values are going to finish the year higher than they are today. Buyers are back making plans, they're looking at properties, they're approaching their lenders for finance, and they're buoyed by the fact that interest rates have fallen, that auction clearance rates are up, that there's positive news in the media, and some commentators suggesting we may have hit the market floor. So welcome to this month's Property Insiders Market Update, where I chat with Australia's leading housing economist, Dr. Andrew Wilson, Chief Economist of My Housing Market. Hi, Andrew.
Hi, Michael. Yes, end of another month. And again, we can look back and review the trends and what's to come.
Well, some interesting things have happened this month. Looking back at some of the news over the last month, despite interest rates having fallen twice in a row, there are now some forecasts that the Reserve Bank is going to drop rates not just one more time, but twice, to get inflation up into its desired band of 2 to 3% and to try and drop unemployment to 4.5%. That's going to be a hard ask, Andrew, isn't it?
Absolutely, Michael. And I certainly have concerns if we drop interest rates below that 1% mark where they are at the moment. I don't think that'll get the result the Reserve Bank is looking for. We really haven't been able to use monetary policy to reinflate economies. This is a lesson that most advanced economies have learned. And even though now we're seeing downward pressure on interest rates and stimulatory monetary policy now in the Eurozone, the US and the UK. I guess it's desperate times in a sense, and it's just a whiff of desperation about the Reserve Bank at the moment. There's no doubt those two cuts to interest rates will help to rebalance the housing market. We're seeing signs of that now. But in terms of the aims of the Reserve Bank for that 4% unemployment rate nationally, I think that what it does is it leaves us exposed without really any ammunition in case we do get a serious global downturn. And certainly the global economy is looking a lot weaker going forward now.
Well, there are issues with the global economy. China's slowing down a bit, America's slowing down a bit. They've still got their trade wars. When we've seen overseas rates get that low overseas, it seemed to be difficult for the banks to pass on the full rate cuts. What can the local banks do?
Well, absolutely right, Michael. The point is that deposit rates now are virtually invisible. And when that happens, of course, there's no real incentive to put your money in the bank. It means that banks have a tough time attracting depositors to keep their margins constant as they cut interest rates for borrowers. And that's why we won't see the full passing on of low rates if they do fall below 1% officially.
The other news this month was the latest ABS figures showing that unit and townhouse approvals have crashed. They've crashed nearly 40% year on year, driven particularly by Sydney and Melbourne and to a lesser extent Brisbane. Similarly for houses, approvals are well down as well. And this is a concern in two areas, as I can see, Andrew. First of all, what's it going to do to the supply side of the market in a couple of years' time? But more importantly, in light of what we were just saying, what will the slowdown in building activity do for our economy and our jobs?
Well, it's a pincer movement, isn't it, Michael? Fewer homes will mean higher prices, but fewer homes will also mean lower interest rates, because that's where a lot of the economic drive has come from. Sydney's still the best performer of the major capitals. It's year-to-date approvals are down for apartments around about 10%. Melbourne and Brisbane, however, are well down compared to the same period last year. And as you suggested, it means where are the jobs going to come from? You know, we aren't going to have the homes to supply demand in the years coming forward. So that'll mean higher prices.
Well, everyone seems to be asking, has Australia's housing market slump bottomed yet? And the first thing to understand is, of course, there's not one Australian housing market. Each state is at its own stage in its property cycle. And even within each state, there are separate markets, separated by price points, type of dwelling and geography. But the median price is often seen as the gauge of how markets are performing. But these are a lagging indicator. They're demonstrating what happened in sales a couple of months ago. Andrew, I know you measure asking prices because they're more timely. They're a leading indicator. They're an indication of what's going to happen. So what does your latest research show?
Well, look, certainly, Michael, looking at asking price data and auction clearance rate data is more of a real-time insight into what is happening in the market. And if we look at those auction numbers to start with, we can certainly see a pickup in particularly the Melbourne and Sydney markets, which have a higher volume of auction activity. The Sydney clearance rate over July, it surged up to over 75%. That's the highest level for 2 years, and well above the 67% that was recorded over June. We saw that for the first time that the year comparisons with the median auction price in Sydney are up by 2% over the year. So we're now starting to see those higher clearance rates translate into higher prices in Sydney. And most of the Sydney regions produced strong results for sellers. So it was interesting, Michael, over the year we've seen for Sydney an increase in sales, an increase in turnover, higher prices, but listings are still down compared to the same period last year. So this is coming from a lower volume level, lower numbers of listings, and that's helping to put a floor under clearance rates. But there's no doubt that the Sydney market is reasserting itself as the preeminent capital city market. Melbourne similarly has a clearance rate over 70%, Michael, in July, up about 5 percentage points compared to June. But a little bit of a different outcome. Prices were basically flat over the year. Auction prices in Melbourne up by just 0.2%. Again, a better result to see some growth. But when we look at the other auction measures in terms of sales numbers, turnover and the listings, we can see a different story there. Very low numbers of properties being listed in Melbourne at the moment, Michael. That is certainly putting upward pressure on prices because of strong competition. And as you mentioned, those asking price numbers, median prices, if we look at the mix adjusted price outcomes for the capital cities over July versus June, we can see that there's been some improvement that correlates with the auction market, particularly in Sydney, and most other markets are just tracking up or down from where they were marginally over June. So certainly we overall have a brighter picture in terms of where prices are heading, and that means that demand is rising. But there's still some work to do, but there's no doubt that the Sydney market, Michael, is looking the best. And the rest are really just, at the moment, treading water until we do get more of that impact from those lower interest rates working its way into the market.
One of the challenges, Andrew, is the low listing numbers. In your experience, how long does it take for sellers to get back in? Are they sitting back waiting to see prices going up, and why should I sell now if things are going to be better in a few months' time?
Yeah, absolutely, Michael. We need to see some consolidated prices growth for confidence to move back into the seller market. Look, most sellers are buyers and buyers are sellers, so it does work its way through the system. But there's more skin in the game for sellers at this point of the cycle, so they tend to be more wary. Once we start to see a consolidation of what are early signs of prices growth, we will see more sellers coming into the marketplace. That doesn't mean we won't see higher prices, Michael, because higher competition for fewer properties will put upward pressure on prices. That's what we're seeing now. So really, I think back to a balanced market by autumn next year, and that's when we'll start to see a market which is evenly balanced in terms of buyer and seller activity. There won't be a boom here, and part of that is because we don't have the investor numbers in the marketplace at the moment.
Just to clarify what you said, home buyers make up the market. They make up the bulk, 70% of purchases, and the booms tend to occur when we have overzealous investors, a whole new generation of new investors pushing up prices, and that's currently not happening, but that's good. This is a more moderate market that makes you time to make good home buying or investing decisions. Andrew, consumer confidence is one of the things that will lead to the market moving ahead also. And this week, the ANZ Roy Morgan Consumer Sentiment Survey showed consumer sentiments picking up again, but people are still a bit nervous. They're stashing their cash. They're not spending at the moment, are they?
Well, that's right, Michael. We have a very low savings ratio. That's no surprise given low incomes growth. And people are now moving or delving into their savings just to survive. I think we're going to see that going forward. We just don't have the income growth that we need in the economy. Look, sentiment surveys are fine, Michael. They do tend to be backward looking in a sense. People read the papers and they figure that everybody's feeling a bit more brighter about things and watch TV or wherever they get their information from. And they react to that sense of things are better or worse. So, look, it's always a good thing to see more positive sentiment surveys. They do just add to the general feeling of the trends in terms of what consumers are thinking.
Now, what's happening with rental markets around Australia, Andrew?
The big trend in rental markets has been the Sydney market, where we've seen vacancy rates have increased over the past 12 months, and rents have fallen as a result. A couple of factors there, of course. So we've had a surge in first home buyer activity, record numbers of apartments particularly coming into the market, and we've seen a weakening of migration as well. Most other markets, however, Michael, are tight for stock, where we've seen not much movement over the month in terms of rental growth.
Well, on balance, there's green shoots. The market is moving in the right direction. And this is going to confound the property pessimists who are always negative. I'd rather say, hey, between 2013 and 2017, we had a boom. Between 2017 until recently, and still finishing off now, we had the downturn phase of the cycle, and the cycle always moves on. So the long-term growth of property values in Australia are underpinned by the wealth of our nation and our population growth. So the long-term trend is up. And the downturns are temporary. We're moving through it. Good times to buy your next home, to look at a private investment property. But there's not a boom ahead, is there, Andrew?
No, absolutely not, Michael. And the disturbances that we've seen because of policy interferences will have some time to run now. And that's the issue with our housing markets, that those questionable policies from APRA that crunched investors and owner-occupiers, the Reserve Bank leaving interest rates too high for too long, is now coming back to bite the economy. Our housing markets is now working its way through that, but there's still some hard yards to do in terms of getting investors back into the marketplace and creating, more of a rational market going forward. But the key question now, Michael, for housing markets isn't so much interest rates, it'll be what happens with the economy, particularly the unemployment rate.
Well, the unemployment rate is one of the things that's going to dictate interest rates. But remember, even if it goes up a bit, it's still so much better. We haven't got people desperately having to sell up their houses. We've got very few mortgage defaults, Andrew.
Well, that's right, Mike. Unemployment doesn't tend to have the same impact, rising unemployment, as rising interest rates on the housing market. And I believe we are looking at a period of higher unemployment despite these cuts in interest rates. That won't have the type of impact that we had with those higher interest rates that really crunched the market in 2015 through to 2018. And
so in this graph that you've just provided us, Andrew, it confirms what you're suggesting, that really only a very small percentage of Australians are paying more than 30% of their income in mortgage payments. It's 2.6% of the population. So we really don't have many people who could be lined up to be in mortgage default.
It's only quite a small proportion who are exposed with those higher levels of their income that they're paying in their mortgage repayments. Again, it's a validation of the sanctity of home ownership in this country, which continues on despite the roller coaster ride of the housing market cycle. And of course, despite the headline chasing of the doom and gloomers.
Well, another interesting month behind us. Thanks for joining us in this monthly property market update. Catch up with you again next week.
Thank you, Mike.